As I mentioned, you declared a distribution of 22.25 cents per linked unit, slightly below the forecast that you had made during your pre-listing statements. You had allocated around 22.91 cents per linked unit, and that is because we've actually seen a delay in the transfer of Bloot Street Mall. Tell us about whether now this is going to be put forward. I know that you've got a target by the end of this month. Has that been done away with?
Yes, thanks. I'll touch on that. I want to make 3 good points for you. I think 22.25 cents, our maiden distribution for the 3.5 months period, to year end of from the 17th of May to year end of August, is actually quite good. We would be ahead of that focus if Bloot Street had transferred on time, 22.95. So we're actually ahead of the focus. Has
it been transferred?
As of this morning, it was lodged. We had, and the delay is really beyond, it was beyond management control, in the sense that, there was a leasehold on the property, or there is a leasehold, which required municipality consent. Local government elections happened more or less the same time as our listing. They had to wait for that local government election before they could give us the consent. It had to go to council. By end of July, it was done, and the normal processes took place, and it was lodged this morning.
So just a slight delay, no real challenges that will come to the fore.
Absolutely.
So in other words, you've got 8 properties within your stable.
You've got 8 good quality properties. They easy to manage. Good regional centres. They break up. 5 commercial properties. Good sovereign underpin, good long-term leases. We've got 3 regional shopping centres, Bloot Street, a community centre at the moment, which we're planning to take into a regional status with the addition of another 16,000 square metres, generally to about just over 40,000 square metres. So, there's a lot of nationals that are not represented there, like the Foschini Group brands, etc., have expressed their interest to go in.
With regards, you mentioned a very strong sovereign underpin.
Yes.
We know that other property companies, property funds have actually experienced trouble with regards to having government as a tenant. What has your experience been? And it seems that you are more shifting towards having a strong sovereign underpin, as you mentioned, as opposed to private sector, where you fear there could be defaults down the line.
Yeah, look, the sovereign gives us a very good exposure as a fund, 40% of our income. In fact, the national government makes up 38%, to be precise, of our income. It's national government. It depends what type of government you're exposed to. There's provincial, there's local government. At provincial level,
Department of Public Works, predominantly, that is your tenant.
Yes. Well, it's only Department of Public Works that deals with all government departments. So invariably, it's the.
And you've got an escalation of around 8% per annum.
8% with those leases.
With long leases.
Yeah, and the portfolio average is about 8.6.
With regards to the split between shopping centres and office buildings, 56% shopping centres and 44% with regards to office. Tell us a little bit about your estimated rental values there, especially when it comes to the office space. Are you experiencing high vacancy rates, and are you then put in a position where you have to start bringing down your rental value?
Look, again, that talks to the fundamentals of our portfolio. We've got very good fundamentals. The fact that we have exposure to sovereign, single-tenanted buildings, virtually we have no vacancy, which is very good. I think if you look at average across the spectrum, 5% vacancies we've seen in the commercial space, largely because of insolvencies and liquidations of companies and so on and so on. We're not exposed to that. So this counter is actually quite resilient because of that.
So your vacancy rate overall is around 5% across
overall
the board?
Is 3% as we sit here, which is largely on the retail side. But on the commercial side, there's virtually no vacancy.
And which areas is that? Because I know that you're operating in East London, Eastern Cape, predominantly, of course, Gauteng and Pretoria.
Our retail centres is Hemingway's Mall, which is a super regional located in East London, Mdansane City. And Mdansane is the second largest township in the country, another regional there, and then Bloot Street Mall. So it's really our vacancy sits on the retail side.
You have mentioned that you're positioned for future growth, but you also talk about the macroeconomic environment, which is increasingly becoming difficult.
Yes.
What kind of assumptions have you put in place going forward? You've also got an increase in electricity tariffs. Are you able to hand that over to your consumer?
Yeah, look, electricity actually is a pass-through, whether it's commercial tenants, whether it's retail. But unfortunately, it's one of those things that are beyond your control. And the only way to try and minimize the impact to our tenants is to try and put a robust energy management into the portfolio in order to decrease. So in other words, you consume less during peak time, and off-peak, they can time their operations in such a way that actually they can make savings and keep those costs relatively the same. Going forward, we've given a range of 85 to 88.3 cents, largely because of the macroeconomic conditions that keep changing all the time. I think latest data, we have consumers who are overburdened with debt. That doesn't bode well for retail going forward, particularly smaller tenants and so on and so on. But we're very confident on the.
Do you have any distressed tenants at this point in time? And I know your vacancy rate is very low across the board, but do you have any distressed tenants?
Well, you'll always have distressed tenants, but I think we've largely over the period worked the tenant mix in such a way that we actually have tenants who are sustainable going forward. We have programs that we run for first-time shop owners, for instance, with retail consultants who come and look at their business plan, their shop fitting, and lighting levels, customer service, and so on, and try and improve those. And we've had turnarounds with all those tenants.
Any more acquisitions in the pipeline?
Yeah, we're looking very good yield-enhancing acquisitions. We're very selective because our investment criteria is very strict. We've got very good quality assets that we don't want to mess around with. So we are looking at very good assets out there. In fact,
where
we should
are
be
you
coming
looking
to
at
market.
assets?
Well, all around the country. I think there's very good, if you start with the government, you mentioned the fact that there's been a lot of noise. But whenever there's noise, people panic. That's when opportunities arise. We've got tick boxes. If something sticks and it ticks all the boxes, we capitalize on the opportunity, and we'll be capitalizing on those.